Hello, Assalamu alaikum students. This is your teacher Azka and today we are going to solve the paper IGCSE Edexel May June 2022. This is not a latest paper, not so much latest paper, but because I found this paper, so that is why I just thought that I should solve this paper. So maybe there are a lot of students who will need this type of paper. Okay, so first of all, we have 10 MCQs at the start of the paper. So the first MCQ is about identify which is a current liability. So current liability is a kind of liability uh, which is basically less than 1 year. So it means that we have to fulfill our liability within a year. So these type of liabilities basically a current liability. So cash in hand, this is basically our current asset. We know that cash in hand is our current asset. So this is not your answer. Inventory is it is also your current asset. This is also not your answer. Trade receivable is also your current asset. So finally, trade payables are kind of your current liability because this is the liability which you have to pay within a year. So your D option is your right option. Okay. So the second question is identify the book of original entry in which original entry is basically your prime books in which irrecoverable debts are recorded. So we know that original entry or the prime books basically the type of books in which whenever a transaction is basically occurred. So firstly, the transaction recorded in the prime books. So basically there are five types of prime books. So there are basically your sales journal. So all type of sales, it will record in the sales journal, and after that, the purchase journal, the journal, return inward, return outward, and cash book. So we know that if any transaction related to in cash form or check form, so it will record in the cash book. And if it is sales return or sales, so it will record a sales journal and the sales inwards. And if it is purchases or purchases return, so it will record in the purchase journal or purchase return journal. And all other transactions with the remaining transaction will record in the journal. So basically, irrecoverable debts will not included in the cash book and the purchase journal, purchase return journal, sales journal, and sales return journal. So it means that it will record into the journal. So this is the right option. Okay, so the next person is identify in which book of original entry a credit note received by a trader would be recorded. So credit note is basically if you are receiving a credit note from your trader, so it means that you are basically returning your purchases because this is a he the trader and you are receiving credit note from him, so it means that he must be your supplier. So if he is sending you credit note, so it means that you are basically returning his purchases. So which type of original entry? So it means that it basically they are talking about the prime books again. So as I told you that it will record in the purchase return journal. Okay. Identify the type of error when a sales invoice of $500 is entered in the sales daybook as 450. So as you can see that amount is the real amount was $500. Okay, and it is basically recorded in the right book, but unfortunately we just entered the wrong amount in the right book. So if the amount is wrong, so it called the error of original entry. So the error of original entry. Okay, so after that, question number 5, identify what will be confirmed by preparing a trade payables ledger control accounts. What will be confirmed? Okay, so if we are preparing the PLCA, so what type of things we are confirming? Okay, so all purchase invoice have been posted. Okay, all purchase invoices has been posted. So it's not like this. We are not confirming this thing. All supplier payments have been processed. So this is also not your answer, because if you are maybe paying your payments to your suppliers in form of cash or in form of checks, so first you will have to record it in the cash book, and after that you are recording into a trade payables ledger control account. But it's not like this, that your all payments done in the year, within a year maybe there are some payments remaining that you have to pay these amounts maybe in future, in next month or in next year. Okay, entries have been posted to the correct personal accounts. So it is not like it is not your right answer, because we know that trade payables as a control account is not for individual account. So that is why this is also your wrong answer. And the closing balance agrees with the total of individual balances. Yes, basically we make trade payables ledger control account, and first of all we have to make the purchase ledger, and after that we are making the trade ledger control account. So in trade payables ledger control account, there are all the balances given. We have to write it all trade payables in the trade payables ledger control account. But if we talk about the trade payables ledger, like your purchase ledger, so in this we have basically maintaining the individual accounts. So we have to confirm our trade payables ledger control account balances with the individual account, so we can confirm that yes, of course, we have written the right amount in the both ledgers. So yes, your D option is your right option. Identify the main purpose of providing depreciation on non-current assets. Okay, so why we are basically providing depreciation on non-current assets, we have to identify the main purpose for it. So the first one, to know the profit or loss on disposal. So it's not like this. Basically, if you want to find the profit or loss on the disposal, so first of all, we have to find the net book value. And after that, we have to subtract the sales proceed from the net book value. So if your answer is maybe in negative form, so it means that you maybe have loss on disposal. And if your answer is positive, so it means that you have gain on the disposal. Okay, so depreciation, basically we are not charging the depreciation to know the profit or loss on the disposal. To provide the funds for the replacement of the asset. So basically, depreciation is kind of non-cash expense. We are not receiving anything in term of depreciation. For example, if our asset is depreciated till now by $12,000, so it doesn't mean that we are receiving something from it. So this is also the wrong option. To show the market value of asset. So we know that net book value and the market value is basically two different things. If you think, according to you, if you anticipated the non-current assets net book value is $12,000, but when you want to sell your asset in the market, but you will find that your maybe asset is not going to sell according to your anticipated net book value. So maybe your net book value is higher than your market value, or maybe the market value is higher than your net book values. So it can be, you can say the difference can be created. Difference can be happen in the future whenever you want to sell your assets in the market. So market value and net book value is two different things. And of course, market value has nothing to do with the depreciation. So this is not the main purpose of this thing. So that is why C is not your option. To spread the cost of the assets over its useful life. So yes, this is basically your right option, because we know that The main purpose of depreciation that we are basically separating the cost of the asset over its useful life. So yes, this is your right option. Identify the accounting concept being described. Okay, so this is basically your accounting concept, and you have to identify that in these four options, which option is correctly identifying this statement. Okay, so financial statements can record only information that has a monetary value. Okay, so this is very easy. So the first one is business entity. Business entity is not right option because business entity means that we are treating our business as separate legal. You can see that our company basically has separate legal identity. So this is called business entity. For example, if we are taking out some cash or goods in maybe for our personal use, so we have to subtract that drawings from our capital. So it means that we are treating our company as a separate legal entity. So that concept is basically your business entity. And materiality concept means materiality concept means that there are a lot of assets we have in our business, but for some business, some assets maybe they consider them as an asset, and maybe for another company, for example, if a big company has a lot of maybe 10 or 15 laptops, so maybe that laptops will not a material for them because it is maybe you can say that very cheap for them, so they will not record its cost and net book value in their book of in their financial statements. But if it is a very small shop and they are operating all their businesses on the laptops, and they have only 4 to 5 laptops, and their business basically running on it on their laptops, so they have basically considered the value of laptops very high, and this will be material for them. But maybe for a bigger company, they will not find a laptop a bigger material. So this is, you can say that materiality concept varies business to business. So if we are not recording anything which is um, we are recording only those type of things which has monetary value, so it means that this is not materiality concept, because laptop has monetary value, okay, but this is not indicating the concept of materiality. And the C option is money measurements. So yes, this option is right. Because why this is right? Because accounting concept says, money measurement says that you should record only that type of things which has some monetary value. So if something has no monetary value, so it means that you don't need to record that into your financial statements. So yes, money measurement concept is the right option. Okay, so the eighth one is identify effect on profits if revenue expenditure is treated as capital expenditure. Okay. So if revenue expenditure is treated as capital expenditure, so what will be effect on the profit? So let's suppose that there are basically office supplies. We know that office supplies are basically our revenue expenditure. And maybe we occurred some expenses of office supplies for $100, but we mistakenly recorded this $100 into a capital expenditure. So what type of thing can be a capital expenditure? For example, your office equipment. You basically debit your office equipment by $100. You basically you want to record your office supplies, your expense as debited by $100, but you mistakenly record $100 in office equipment. You just debit the office equipment. So it means that office equipment are Basically, this is our asset. So your asset is increasing, and because you didn't record $100 into your expense, so it means that your expense is decreasing. Okay, so if your expense is decreasing, so what does it mean? That your profit for the year will be overstated. Your profit of the year will be overstated. Okay, so yeah, so C option is your right option. Identify the principle of professional ethics being described. Okay, so accountant must make their own judgments on the accounts. Confidentiality, integrity, objectivity, or professional behavior. Of course, if accountants must make their own judgments on the accounts, and it is basically objectivity, because whenever you are making any judgment on the basis of your number, on the basis of your number performance, so it means that this principle is basically your objectivity principle. Okay. So the last one MCQs is identify the double entry to record goods taken for personal use by trader. So we know that whenever we are taking out something as our personal use, so it means that we have to debit the drawings, and if we are basically taking out goods, so it means that we have to credit our purchases because we have to less our purchases. Okay, so A option is your right option. Okay. So in 11 question, identify the source document for each transaction. Okay, so we have some bunch of transactions, and so we have to write that which type of source document will be used in these types of transactions. Okay. So our first transaction is return goods to credit supplier. So whenever we are returning goods to our credit supplier, so it means that two types of source document we can use: the credit note or the debit note. Purchase refreshments for the office. So whenever we purchase the refreshment for the office, and most of the time refreshments basically we supposed to purchase the refreshments for the cash. So whenever any type of cash purchase is there, so we will use the receipt document. Received bank interest. So we know that after 1 month, our bank basically will send us our bank statement, and in our bank statement, we will see that what type of transactions, maybe how much amount we withdraw from our bank, and how much amount is basically direct debit to our accounts, or what type of amounts which we maybe deposited in our banks. So all these type of banks transactions are recorded in our bank statement. So of course, if we are receiving any bank interest, so it will recorded on the bank statement. So bank statement is the type of a document. So in this document, we will see that we will see our whole month's record. Purchase a non-current assets on credit. So whenever we are purchasing any asset, or maybe any other, for example, current asset on credit, so only one document will be used, which is your invoice. Receive a check from the credit customer. So of course, check is your if you are receiving check from your credit customer, so check is basically your source document. Okay. So, state one difference between the objectives of private sector organizations and public sector organizations. Okay. So, this is very simple that we have to identify that how private sector objectives are differ from the public sector organizations. The objective of private sector organizations is to generate a profit whereas public organizations is to provide a service to the general public. Okay. So the third question is identify three stakeholders that may have an interest in financial statements of a private sector organizations. Okay. So we know that we have different numbers of stakeholders: government, your tax authorities, your customers, your investors, your shareholders, and your employees, your owner, your banks, your suppliers. Basically, these are your stakeholders. Stakeholders basically that type of individuals or maybe the corporations or maybe the government, which will be influenced by your financial statements. Okay, so if we want to just write any three, so we can say the first one is honor, because of course, if you are making loss in your financial statement, so honor will be greatly affected by it. And the number two can be your banks, because banks are also concerned because they are giving you loan, and that is why they concern for your financial statement, so they can better analyze your performance and they can make the decision that whether they want or whether they should give you any loan or not. And the government, why government is concerned, because government need to know that how you are performing right now, so in future maybe government can give you some grants, and maybe government make changes about taxes. So that is why. And the other thing is that maybe government wants to impose any extra tax on your profits. So that is why government is also very concerned about your financial statements. State one accounting concept applied when making a provision for irrecoverable debts. So basically, there are three types of accounting concepts. The number one is prudence. Prudence says that you should not overstate your profits and overstate your assets. So if prudence says that you should not overstate your profits, so it means that you should record your expenses. If you have a doubt that maybe in next year your irrecoverable debt would be high, so you will always try to set a high percentage on your irrecoverable debt as your provision. Okay, so it means that by making sure this thing, you are applying prudence on your financial statements, because you don't want to overstate your profit. And Yes, so you can say that prudence is one of the accounting concept which we are using when we are making the provision for irrecoverable debts. Okay, so the is state one difference between an irrecoverable debt and a provision for irrecoverable debt. Okay, so basically, irrecoverable debt is this is amount owing to a business that will not recoverable. Okay, so irrecoverable debt is basically the amount which our customer is saying that we don't pay or we cannot pay because we just go bankrupt. But the provision is just an estimate that okay, this much amount of our trade receivable maybe in future it will convert into irrecoverable debts. So this is basically the difference between irrecoverable debt and provisions. Okay, so identify indicating with a tick in which section of the financial statement each would appear. Okay, so decrease in the provision for irrecoverable debts. So whenever our provision is decreasing, so we always treat this thing as our income. And if it is increasing, so always we treat this thing as our in expense, and we don't record this thing in our financial statement. So that is why it will only record an income statement in the income section. Um, so there are nothing else recorded in this boxes. Okay, so balance of provision for irrecoverable debt. So whatever the balance we have in this year for the provision of a recoverable debt, so we always subtract this amount from the trade receivables in the statement of financial positions. So that is why, because this trade receivable is a part of our current asset, and we are basically deducting the balance of provision for irrecoverable debt accounts from the trade receivable. So that is why we will record this thing in the current asset. Okay, so our trader provided the following balances on 31st March 2022. Prepare a trial balance, entering any difference in the suspense account. Okay, so after that, we have to make the suspense, the journal entries for suspense account. And yeah, okay. So first of all, bank loan, we know that the nature of the bank loan is credit because this is our liability, so it will record in on the credit side. Bank overdraft, this is also our liability. Carriage inwards, this will be your debit because this is your expense. Drawings also, it will also debited. Equity, this is your capital basically, and the nature of the capital is credit. Journal expenses, it will be debit side. Inventory at 1st April 2021. Okay, so this is basically, I think it is our opening inventory, yes. So it will record it on the debit side. Just remember one thing, that closing inventory will not record in the trial balance because this is not the cost of goods sold for the current year. Okay. So irrecoverable debt, which is 390. So this is also our debit because it is our expense. Motor vehicle cost. This is our asset. So also this is recorded on this side. Motor vehicles provision for appreciation. So provision is always carried. Purchases, which is 69220. Sales, its nature is always credit. Trade payables ledger control account. This is also a liability. Trade receivables, this is our asset. And asset's nature is debit. Okay, so just let me total it. Okay, so we have balance on the credit side, which is 143760. And on the credit side, we have 143870. Okay, so it means that the difference is basically for 110. And because your credit side is lighter, so it will suspense is basically coming on the credit side because you have your debit side is higher than your credit side. So by which amount of your debit side is higher than your credit side, you have to write this amount on that side. So your credit side is lighter than your debit side, and the difference is 110. So we have to write 110 as your suspense. And now we are going to balance both sides. 143,870, 143,870. Okay. Okay. So after that, after preparing the trial balance, there three errors were discovered. Okay. So the sales account had been undercast by 200. Okay. So sales account basically supposed to be credit. Okay. But if we undercast, so it means that we undercast, we did not record this $200 in your sales account. We undercast it. So whenever we undercast it, so it means that we have to record, we have to increase our sales account by $200. Okay, so what we have to do is we have to credit our sales by $200, and where there is nothing, debit side has nothing, so suspense account will be there as a reference. Okay, so the second error is a payment of 218 to Johanan, a credit supplier, had been entered in the bank account correctly. Okay, so you basically paid a 2018 check to Johan, and he is basically your credit supplier, and you recorded this transaction on the bank column in the cash book, but had been posted to Johanan's account as 128. Okay, Johan's account. Okay, so basically you need to record 218, but you recorded 128. So let's find the difference. 218 minus 128. So the difference is basically 90. Okay. So the amount was 218, but you mistakenly record 128. So it means that you decrease the journal account mistakenly. So that is why we have to increase now the journal account by 90. So it will record on the debit side. Johan account 90, and on the credit side you have suspense 90. Okay. So the last error is a check received of $130 from C Green. Okay. A credit customer. So he is your credit customer. So you received $130 from him. Had been credited to the bank account and debited to the account of V Green. So we think that okay, maybe V Green is also our customer, but we mistakenly record 130 into V Green account. So it means that we have to record 130 in C Green accounts first, and after that we have to record this in C Green account. So whenever you are receiving any amount from your credit customer, so your customer will be credit. Okay. So okay, so after that we have question number 15. Martina, a retailer, maintains a full set of accounting records. On 1st April 2022, Martina owed Rafa $640 for goods supplied. During April 2022, the following transactions took place between Martina and Rafa. So these are the transactions. So we have to write that in which books of original entry these transactions would be recorded. So the first one is purchase goods. This price was 850 less a trade discount of 20%. So we know that whenever we are purchasing something, so we have to record it in the purchase day book, or you can see the purchase journal. Okay. Return goods list price was $100 from the order received on first 12 April 2022. So of course this will record in the purchase return journal. Okay. Paid the balance owing at first April 2022 by credit transfer after taking a cash discount of 5%. So yes, of course, if you are paying something, so this is your cash transaction, so it will record it on the payment side, credit side of the cash book. Okay. Prepare the account of Rafa for the month of April 2022. Balance the account on 30 April 2022 and bring the balance down. Okay, so we have to maintain the Rafa account. So who is Rafa? So on 1st April 2022, Martina owed Rafa. So it means that Rafa is our supplier because Martina owed 650 to Rafa. Martina supposed to pay back 640 to Rafa because Martina maybe purchase some material from it. As we can see that there are transactions which Martina have with Rafa. So it means that we have to record this 650 as our balance BD on the credit side. Okay. So after that on 12 April, Martina purchased goods from the Rafa and the list price was 850 and the trade discount was 20%. So we don't need to record this trade discount, but we have to deduct this trade discount. So 850 multiply 80%, or you can say that 850 multiply 20%, and whatever will be your answer, you have to deduct that 20% from the 850. This is your choice. If you want to directly multiply 850 with 80%, so answer will be same. So 680 will be our answer. So it means that after deducting the trade discount, the basically the amount in the amount which you will pay or in which you purchase the raw material from the Rafa will be 680. Okay, so on 19 April, the return goods list price was 100 from the order received on 12 April 2022. Okay, so whenever we are returning the purchases, so we have to record it on the debit side. So the list price was $100 and this was the goods which we purchased on the 12 April. So just remember that we had 20% trade discount. So it means that we have to apply that 20% trade discount on these return goods also. One hundred multiplied 20 divided by 100. So this will give you 20. So 100 minus 20 is equal to 80. So the worth of these goods are basically 80. So we recorded this transaction in the purchase return journal. So that is why we are writing purchase return journal. Rafa account is debiting and purchase return journal is crediting. Okay. So after that, okay, so 29 paid the balance owing at first April. Okay, so what first April we owing Rafa $640 by credit transfer after taking a cash discount of 5%. So that was 640. Okay. So first of all, try to know that what was your cash discount. I think cash discount was 5%. Okay. So it means that we received 5% cash discount. So we don't need to pay 640 to Rafa. So because she gave us some discount. So the discount amount is $32. 640 minus 32, which is 608. Okay. So basically, because we credit transfer to Rafa, so that is why this basically would have been recorded in the cash book. So that is why we are using the reference of cash book 608. And we of course received discount. We have to write it here. Just remember one thing, that we don't need to record a trade discount here. Yes, but whenever we are receiving discount, so we have to record this discount in the individual's ledger, individual sales ledger or purchase ledger's account. Okay. So now just total it. The total is 1320. So your debit side is your lighter side. So just subtract 860832 from the 1320. So you will have your balance CD, which is $600. And it will be your opening balance for May. It means that you still need to pay $600 to Rafa. Okay, so we have done with this part. State in which section of the statement of financial position at 30 April 2022 the balance of Rafa's account would appear. So it is very current liabilities because Rafa is our supplier. Okay. So the next question, Martina currently offers only cash sales and proposes to offer carry terms to her customers. Evaluate whether Martina should proceed with this proposal. Okay. So basically this question is for 5 mark. So it means that we have to write advantages or disadvantages of this option. And after that, we have to justify the answer, and we have to advise the Martina that what should she do. Okay. So Martina currently offers only cash sales, okay, and proposes to offer carrot terms to her customers. So it means that currently she is not doing any carrot sales. She is just offering cash sales, but now she is thinking to propose a carrot terms to her customers. So we have to evaluate that whether Martina should proceed with this proposal or not. So first of all, we have to write two positive point for this statement and two negative point for this statement. And after that, we have to advise the Martina. Okay. So we can say that If Martina would propose credit terms to customer, so it will attract more customers. Okay. So of course it will increase her turnover and profits. And the number two is, if we talk about the negative points for it, negative point. So if she proposes the credit terms to his supply customer, so what will happen? Irrecoverable debt. Because if she offers credit terms to her customers, so of course maybe her customer maybe in future will not pay her debts, and maybe they will bankrupt. So that is why irrecoverable debts exceptionals are also there, so which will decrease profits. So lastly we have to give the advice. We can say that Martina should or should not proceed with this proposal. Okay. State two, advantages of preparing a bank reconciliation statement. Okay, so first of all, it assists in preventing frauds. Of course, if there is something wrong with the cashier, if he did some fraud, so we can easily deduct from the bank reconciliation statement. And the other thing is, it identify the unpresented checks, because we just given the checks to our suppliers, but if they didn't withdraw it, and this is the thing which we can not know from our cash book, we have to analyze our bank reconciliation statement, and after that we will know that uh, that our supplier withdraw the amount from the bank or not, from our bank account or not. So it will also identify the unpresented checks. Okay, so on 28th February 2022, Nabil's bank statement showed a credit balance of $135. Okay. On the same date, the cash book showed a credit balance of $180. The following had not been entered in the cash book. Okay. Prepare updated cash book to show the adjusted balance. ठीक है. First of all, we know that our balance BD is 180, but it will be on the credit side because we have credit balance. So balance BD would be $180. Okay. So now let's read the transactions. A direct debit for telephone, $42. So this is basically a debit. So it will be on the credit side because this is the payment side. So telephone 42. Okay. Dishonored check from Barjay Limited 668. So it will also on the credit side because we recorded it on the debit side because we thought that we just received a check from our credit supplier, but after that we get to know that this check is basically dishonored check. So that is why we have to deduct it from the credit side. Our credit transfer from BX trading 475. So it means that we received something from the BX trading. So if we receive something, so we have to record it on the debit side. Okay. So cash sales banked 295. Okay, so this would be on the debit side because this is also our receipt side, our earning side. Check drawn for cash $120. This is also your payment side. So now just total it. So our debit side is shorter. So just subtract this 475 and 25 from the 1010. So we have balance CD, which is 240, and it will be balance PD. So it means that we have negative balance in our updated cash book. Okay, so at 28 Feb 2020, the following had not been yet processed by the bank. So this is basically two things which a bank did not record. Prepare a bank reconciliation statement. So we have uh, our revised balance, or we can say the updated cash book balance. Updated cash book balance, which was 240 negative. Okay, so we have unpresented checks, which is 562. So it means that we just give that 562 check to our supplier, but um, fortunately, he didn't withdraw this amount from our bank account. And the number two is outstanding lodgements, which is 187. So this is outstanding, so it means that bank need to deduct this from our account. Okay, so first of all, you need to deduct this. Mm, outstanding lodgements. We are adding this 562. Why? Because maybe after some time, the supplier would um the supplier basically would withdraw this amount from our bank account. So that is why bank will be add back this amount, and our balance as per bank statement would be 135. Okay, so state in which section of statement of financial position at 28 Feb 2022 the bank balance would appear. Okay, so our bank balance was 240, which is in negative. So this is basically our bank overdraft. That is why it will be recorded in the current liabilities. Okay, state two causes of depreciation. Okay, so there are a lot of causes. So number one can be time factor. With the passage of time, every asset would be depreciated. And the number two is technology